Strike prices, strike prices, strike prices. You can't trade options without two critical pieces of analysis. You have to, with every single trade, you have to pick a strike price and you have to pick an expiration. Now, there's a few more things that go into it, of course. Direction, which type of strategy. We're running a debit credit spread, vertical, your verticals, aka verticals. A call, a simple call or a put, iron condor, a back ratio, a straddle, a strangles, all these different types of options, strategies that make you money in different ways. But if we return back to the basics, just a call and put, I'm either bullish or bearish. I believe the stock is going up or I believe it's going down based on whatever indicators that I use. What strike prices do I select? That's the question we're going to look at today. Welcome to the channel. My name is Noble Woods, and what I'm going to do is I want to give you a simple concept that I think will help. Again, this is going back to basics. We're going to keep it really simple. We got to talk about what is a strike price. Why do we need to select well? What are the implications, good and bad? There's a couple things you need to think through, but this is like newbie 101. So I'm not going to go too deep. But I do want to give you something that I think will help. I want to introduce a new concept to you, something that you can use every single time you go through the decision-making process of buying any sort of options contract, specifically though the most basics, calls and puts. And that term, that concept is called a strike range. So we'll get there, but before we jump to strike ranges, let's first talk about what is a strike price. What is a strike price? So I'll read the technical definition. A strike price, also known as the grant price or the exercise price, is the fixed cost that you'll pay per share in order to exercise your stock options so you can actually own them. Now, again, coming back to basics, what the heck are options? That's a whole nother video that I'll link this to eventually. Right. But if you believe the stock is going up, you can pay full price. Costco right now is $892 per share. It's a bit pricey, right? $892, might as well say $900 per share. So another way to take advantage of, and actually let me just might as well pull this up first. So today we're going to talk about strike price. I just gave you the definition. I'm actually going to use Costco for a couple different reasons, but I'll use Costco today. We will talk about in the money, at the money, out of the money. What the heck does that mean? What are the differences with those three? And then we're going to talk about how probability equals price. I want you to really understand what options is. Every time you buy a contract, the price you're paying for that strike price is connected to probability. Right. And then I want to introduce strike ranges at the end to just bring it all together, give you a nice little simple concept. This will not be a long video. Matter of fact, I'm setting my timer. Last two videos I did today were like an hour. I'm tired. So today will be nice, short, sweet, to the point. Okay. Let's do this. Let me pull up a chart. And the example that I wanted to walk you through, I'm actually going to go back. That's a key critical candle there, but let's just go here for a second. All right, so this is the monthly chart. This is Costco. If you've never bought, you don't own any Costco, if you've never thought about investing in Costco, if you don't shop at Costco, I think you might be missing some key things to not only just great value and prices for the actual being a member, but this really is a great analogy for the options market. Costco, Sam's Club, BJ's Club, they're literally like it's like the perfect metaphor for trading options. Why? Because you're buying different items in bulk. You're never paying full price when you go to these stores. You're getting a huge discount because you're buying in bulk or wholesale, or what I tell kids whenever I get the chance to teach kids, you're buying a whole lot on sale. That's all. right? You're buying a whole lot on sale. You're getting a nice discount. And that's essentially the core of options. So instead of paying, let's see, we closed at 892.38. You could right use your indicators. You could use a system to try to predict where Costco is going, but it's pretty pricey. I don't think the average person would be able to buy 100 shares. It's 900 times 100. That's some money, right? So you can use options. 90% of people who use options are just using options to make money. They're not trying to exercise the contract. They're placing a trade. It moves their direction. We've made some money. We bought in one contract, there's 100 shares. Now, we're not getting the full value of those 100 shares, but to keep it simple, we're borrowing 100 shares every time we buy an options contract. I always use this example. Matter of fact, let me show you. I always use this example. You could be walking around whatever store. You could buy a bottle of Dasani water. I know some of y'all be hating on Dasani. I like Dasani, whatever. It's not the best though. Essentia is the best. You could buy one bottle of Dasani for maybe like, what is that, $2.99 somewhere at a gas station. You're randomly in Target, right? Okay, $2.99. But if you went to not too far from my house is a BJ's Club, and there's a case that I pretty much get like every week for $32, and I think it's $6. So think about that. $2.99 for one bottle, or you're only paying pennies. What is that, 25, 30 cents? So you're getting a huge discount. Same with options. You're not going to pay $8.92 times 100 on any of the contracts that we could actually pull up and look at, right? You're getting a discount. So again, this is not options 101, the math and how it works, this back end calculus, the Black-Scholes model, which is what it's based on. But I had to give you a little bit of that just so we can get to the core of what we wanted to look at today, which is strike price. So I have to know, where do I believe it's going? So the mistake I think a lot of people make with strike prices is you really have to realize that you first need a target. Where do you believe price is going? The simplest, easiest target is always the last swing high if we're bullish. If we're bearish, it's the last swing low. All right? I'll draw this out. Don't worry. I'll give you some numbers. I actually want to go back here. Again, these are month charts. I'm on Costco for a reason, like I told you, because it's so easy to talk about options and kind of like make it really stick. So I'm really kind of doing like two videos in one, right? If I can just get you to get that options is just buying wholesale shares. That's all. It's just buying in bulk at a really, really big discount, which is why you can make so much money, much higher percentages than buying the stock directly. It doesn't really make mathematical sense to buy the shares directly just to make money. Now, if you're talking about holding those shares, different, slightly different conversation. But again, research shows 90% of people who trade stock options are not trying to exercise the contracts to buy more long-term shares. They're just placing a trade, hoping that price and volatility go the direction that they forecasted. And when it does, we make money. Very simple, right? So let's do this. I want to put, I'll put a few things back on my chart. This is a Noblewood's recipe. These are this is the one. This is positive one, negative one, standard deviation. These are Bollinger Bands. It's probably the most perfect tool you can use. A lot of people don't understand it. I've heard terrible, terrible things about Bollinger Bands for years. And because I actually understand stats, have an MBA, have used this in different forms of analysis for work. I love stats. I know a lot about standard deviations, right? So I think this is probably the most perfect indicator if you actually understand what the definition of volatility is, right? So what I want to do is I want to look at this specific month. Now, I know this is going back in the past, yes, but I'm just using this for teaching. All right, so I can use whatever I want. This is a good, simple example to use. The Bollinger Bands in here, as you can tell, when we were here, you can see them start to compress and get really tight. What's happening when that happens? This is usually the sign that we're in a range or about to range, right? As you can see, we are in a range. Where's the range? It's this big ugly bar back here this month, which was what was that? May of can't see the year. Hold on. May of 2022. All right, May of 2022. So if I stretch that out, we're just ranging. All right, that's why these Bollinger Bands are slowly month after month. They're getting compressed. They're getting tighter. Why? Because the average price, the average where people are buying, the range isn't as wide. It's more constrained. It's tighter, right? Because we're waiting to get out of this range. But the good thing about these ranges is we always get out of ranges. At some point, we usually are going to break out to the upside or to the downside, right? That's the beauty of ranges. So let me take this off my chart again. And there's a few things that are right here. This candle is also your classic bottom-tailed hammer, right? It means we push down this month, totally reverse push all the way back up within the same month. That's a good sign. Actually, that candle by itself is very much so. Is like one-on-one technical candlestick basics. It's a reversal sign. It's telling you that we pushed down, but we didn't have enough volatility. We didn't have enough strength to stay down. Bears flipped in that month. We pushed down, bears are winning. By the end of that month, bulls were winning. All right. So I want to just focus on that candle for a second. Let's say because of several factors, but just again, without being able to go through everything, let's say that this is the candle that you've identified. I think this trend is going to return back into its main direction, which is up. It's bullish, right? And you find this month as a month where if we can get above this high, I think we're going to be able to get back up. I know Bollinger Bands get tight. That means the data is again compressed. Nobody's really trading. People are afraid to put size on the table. This is when the ranges happen. But we got to break out of this range. Costco's an amazing stock. It's been bullish so long. If I showed you the full chart, matter of fact, let me show you the full chart. I'll go to a quarterly chart for a second. Look at Costco. Look at Costco. This is years upon years upon years upon years upon years. It's probably one of the most beautiful charts in the entire market. You don't see people talk about it a lot for a reason. It's pricey. It doesn't have a lot of volatility, a lot of liquidity. So it's options contracts. They don't kind of give you the bang for your buck that you really like as compared to like Microsoft or Apple, right? I could go into that, but trust me, it's just not one of those stocks that a lot of people trade. All right, I'm going back to the month chart. So again, incredibly bullish stock, crazy bullish. Had to give you that as some context. All right, so again, we're here now. We're thinking about this one specific candle. So I'm going to draw a couple lines. If your entry was above this candle, because you're like, you know what, this stock is crazy bullish. We just got stuck in this range. The bands are getting tight. That just means price is slowing down, which really means we're getting closer to a breakout. I don't think this stock is going down. I want to give it some time. Maybe I give it 6 months, maybe a year, and just relax. Right? On the month chart. So what strike price do I pick? Think of your strike. Think of strike as like a match. It's really where you want price to go. And when price gets there, it's like, oh, we hot now. Right? That's where you want price to go. So if we're buying calls, which we would in this case, right above that bar is, let's just say 500. That's $500 right above. So if price pushes up, that's where we would get in. If we wanted to play it safe, we would buy at the money, Make a quick note, right? So that 500 is basically at the money, right? Essentially, it's where price is at the time we're buying, which is why the delta, I'll have to do another video on delta, but one of your main Greeks, the delta right at the money strikes is virtually always like 50-50. It's just for the same reason you flip a coin. It's 50-50. Why? Because it has to go up or down. So if right now we were buying this live as prices at $500 and we buy the 501 strike or maybe the 499, if we're at 500, it has to go up to 501 or down to 499. So that 499 and that 501 strike, it's kind of like 50-50 almost. All right, you're paying for probability. Those at the money strikes, they're going to be, I won't say premium, but they're going to be like what I almost consider like MSRP, normal cost. Right. If I bought any strikes that were lower than 500, that's our entry, that $500. If anything lower than that, we're already beyond that price. Right. So if I said, well, what if I just wanted to buy these contracts, give them 8 months, and I just wanted to go like, can I pick a strike price that's lower than where we already are? We're at 500. All right, right here as we broke that line, we were at 500. What if I wanted to buy the strike that was the 460? Yes, you can do that. What's the advantage to doing that? It costs you more, but there's a higher probability in 8 months that price will be above 460 plus break even, which is where the math gets just a little tricky, but I'll just keep it simple today. 6 to 8 months from now, the chances that we're above 460 are simply higher than, it's a higher probability than the chances that we'll be above 500. Because we just broke through 500. We were already past 460. Higher probability. So, just want to draw this real quick. So down here is our old ITM, which is in the money. In the money. So everything below 500, in the money. It's safer. We've already passed it. Good probability, a higher chance that if price just continues to go higher, we're getting further away from that strike price, which we've already passed. Now, it doesn't mean you instantly, once you get in the trade, are making money. No, because you have to actually think about how much it costs. So there's a little bit more math included. But again, I'm just trying to keep it simple today. Matter of fact, I'll take this arrow off. Oh, no, I'll put it on the right side. Oh, I still took it off. Hold on. Okay. And then anything above, anything higher than 500, if I go out to 520, all right, and check this out. Where are my last two major swing highs? This one right here. This one here, I'll do 3. And this one here. All right, so if we get all the way back to the all-time highs, $600. If we get back here, we can get above that candle we were ranging in. We should get up to 550. If we stay inside the range and just get back to this top band, that's about 530. All right, so I'll draw a couple lines there. So 530 is a place we could go. 550 is a place we could go. 600 back to all-time highs. So think about this. If we just broke 500, the day we were crossing 500, if somebody said, hey, I'm buying a $550 strike, you would say, whoa, what makes you think we're going to get way up there? That's further away. Yeah, it's further away, but it's cheaper. Why is it cheaper? Because it's further away. When you trade options, you're literally playing a game of probability. That's all it is. It's a game of probability. So you're paying for higher probability of price going that way based on the fact that at 500, it has to move $100 just to get to where your contract would then now be at the money. We want to get you to being in the money. Like we want to get that contract. We want to reach that price. But at 500, that's $100 away. So to go that far, you need some time. You need a catalyst. You better be right on direction. $100, that's a lot of money. That's a big move. So if you were to buy, if we were here at 500, the in the money contracts, expensive because there's a high probability already built in that we will be above 460 6 months from now. If we give our contract 6 months, it's a really good chance we'll be above 460, 480, anything under 500. But those are premium. They're expensive. The at the money is basically where we are at the time you place the trade. We were at 500. That was the entry for this trade. It's right there at 500. Those are going to be cheaper than the in the money. Now, if we go out to 530, those are cheaper, lower probability of getting there, though. If we go up to 550 to here, even lower probability. Those are even cheaper because it's further away. And again, if we go to the 600, even cheaper because it's further away. So hopefully that makes sense. Let me pause for a second. Again, strike price, a big pretty word for where we want price to go. 90% of people are not exercising and trying to actually buy the contracts when they use buy the shares when they use options. Most people aren't exercising the contract. So I have always just, once I found that data, I was like, yeah, I might as well just always think of options as for income. That's actually why I call my my 4-week class options for income, because most people are using options as just extra income. All right. So that's at the money, in the money, out of the money. OTM is out of the money, right? It's almost like it's out there. It's way out there. We got to reach out there. We got to get there. Lower probability, cheaper price. The problem is, and this is what I've seen hundreds of people do. You get in this game, this profession, this field, and you think, oh, everything you buy is cheap. Because I also have to think about time. And then that's another factor. The further you buy your contracts out, the more time you give them, the more expensive they are because it's a higher probability. You have more time. Right? So expiration and strike price, they're literally both based around the principle of probability and reaching that price or that time limit. All right. So here's the question. What's the right strike price to select? Here's where the price, strike price ranges come in. So let me show you this. It's another conversation to start talking about the timepiece. All right, that's a whole another piece of this. But if we keep this simple, I would tell you any day without even blinking that the range of strike prices that make logical sense is literally anything from this high, because we can get there. We can always get back to the old highs. That's the whole point of the stock market. We love breaking highs. The whole world goes crazy when the S&P hits new highs. Everybody knows, everybody's talking about it, but can you get in before that is the question. All right, so to keep it really simple, I would say most people are not buying in the money because they are more expensive. Most people are price sensitive. Most people are not buying in the money 60, 70% delta, 80% delta strike prices. Most people are buying at the money, out of the money to get them a little bit cheaper so you can actually make some money. All right. So I put a range. I put a box from the at the money price all the way to the last high. I'm on the month chart. Did we get there? Yeah, we got there. Let me show you what happened. So this is what happened. All right. We entered that sort of trade setup. We hit 500 in June. Got to select your strike price. Some people would have said, you know what? I want to go further out. I want to get these to 600. You got to give those more time. Again, this video isn't about time. It's just about the kind of the core understanding of just in the money, out the money, at the money, and then a range. Right? That range for me is basically the last high down to at the money. Right? Again, you can always go lower. You can buy safety. You can buy in the money. Sure, you can. You definitely can. But most people aren't doing that because price is a constraint. Most of us are trying to be a little bit more savvy with buying. Right? And so the tricky part about this, though, which I always say, and my students know, I say this like 1,000 times in class. The thing that makes trading kind of tough, I don't say makes it tough. It's just an annoyance. It's one of those things that's just, it's a very vexatious part of this, which simply just means annoying. Right? I like words. Ranges. Oh, when we get stuck in a range, that's what makes picking expirations a lot more difficult, because you don't know if we're gonna get stuck in a range. Right. And so if I just go here to these candles, we got back to 600. Of course, we went higher, blah, blah, blah. But right here. This first candle that crept above the one, we ranged inside of that candle for 1, 2, 3, 4. Virtually took 5 months just to get out of that range. That's what makes selecting the time with options tough, because you never know if we get stuck in a range, and we can get stuck in a range and for 10 bars go nowhere. And notice I said 10 bars. I didn't say 10 months. I said 10 bars because if we're on the 5-minute, your day trading options, yes, you might get stuck for 50 minutes, just ranging, going nowhere. You can get stuck for 10 weeks. You can get stuck for 10 months. You can get stuck for 10 quarters. It happens. That's why I'm always showing you guys different time frames. Right. So again, you never know when those ranges are going to happen. But if we're keeping it really simple, like really, really simple, the range of strikes that makes sense. You also have to think about time. Can we get back to the last high? And then anything at the money to that high, to me, is fair game. But you got to think it through. If you were the person buying a $600 strike, you need to give those more time than the person who's buying at the money, because we're already at 500. In that first month, we closed at 524, right? So the person who bought the $500 strike, by the end of that first month when we got in the trade, we're already up $24. We're $24 in the money, $24 beyond my strike price. If you bought that 460 contract, yeah, it's more expensive, but now you're, what is that? $64 in the money already. So you're paying for safety. You're buying probability when you buy your strike. And again, that's only one factor. It does not include, right? So I'm only talking about your strikes, but it's almost impossible to not at least mention expiration, even though this video is not about expiration. So I know that's pretty simple, but yeah, it really is that simple to me. If I, actually, no, I won't do that. I was about to kind of jump around, but I don't want to do that for a reason. Come on, Johnson. What's up, man? He said 3 videos in one day after not posting on Thursday. Way to over deliver. Yeah, man, I appreciate it. I have fun, man. I love what I do. I really do. And again, very soon I'll let you guys know I'll be dropping like 3 to 4 videos a week. And then once that starts, consistency. 3 to 4 every week. They'll be short, 15, 20 minutes. Exposure, challenge you on some things, expose you to some new things, teach you some things I know nobody else, or at least I don't see anyone teaching, because I want to always add value. So that's about it for now. Again, let me go back to that chart one more time. Let's say you're the person who says, you know what, I want to play it a little safer. I want to buy the 530 calls. Okay, cool, buy 530. They will be cheaper than the person buying the 550. The $600 way out is cheapest, yes, but you probably also need to give it more time to get there. So there is this equation between, like, how close are we to that price? Where are we on the chart? And the chart itself is giving you some insight into volatility. What actually is the intrinsic volatility of this options contract, this specific stock? What's the average month, right? Just the average range per month, right? A lot of questions, a lot of things to think through. But I think if I had to give you guys something safe to just kind of like frame your thoughts around it and capture this, like, okay, wherever I'm buying, if price is at 500, that is at the money. I am buying the strike that is at the current price. Anything beyond 600, think of it like this too. Anything beyond 600 is like, it's probably not realistic. Why? Because we like to test highs. We will go directly to a high. We'll go to 590 and drop. We will go directly to 600 to test that old high and drop. Because all the people like me who made money up to 600 are like, hey, I'm in the money now. I've done well. Oh, and then let me say this too, because I didn't. In a general sense, those out of the money strikes, the 530, the 550, and the 600, they're generally speaking going to make you a little bit more than the at the money to a lot more. So there really is this beautiful, beautiful math that works with the out of the money strikes. But again, are you giving them enough time? People who think they're smart starting off do that, right? You buy dirt cheap, you don't give them enough time, you just lose. Everything you bought was cheap, but you're losing a lot because you really don't get that this is a game of probability, right? And so you have to have some sort of grounding in what tells us that we're going to get to those prices, other than just that they're the last high, last swing high, right? Last major high. Yeah, that matters. Everybody would have saw 600. There's nobody who would have looked at this chart during this period of time and not said, oh, I think we might get back to 600. All right, why? Because that was the last major high. Everybody's paying attention to the high. All right, so that's simple. Fifth graders can do that, right? That analysis. Honestly, fifth graders can do this analysis to give you a strike range. What's the last major high or low, depending on direction? And then from at the time we're buying, based on whatever systematic entry we have, right? That price is the at the money price all the way to that higher low, because we're probably going to test the higher low because that's all that the market does. It's one of the most common phenomenon in all of trading, right? We have to test the highs before we can go higher. Pull back, then go back up, test the high, break it, go higher, right? So real nice, clean example, as you can see, we ranged for those 5 months right there, and then Costco just took off. Amazing stop. So I just wanted to kind of expose you to that as well. And I think that's about it for this one. Thanks for watching. Share this video with somebody that you know and that you love. Make sure you subscribe. Click the like button. Helps the algorithm get this out to more people. Feel free to shoot me some feedback or questions in the comments. I love that. And then if you're really curious, you're like, Noble, I love these videos. I love what I'm learning. Love the perspective. You're using your MBA. You're pulling all these skills together. Thank you for like trying to really teach us something. If you want to work with me directly, how do you do that? Click the link below. You will get access to, I think it's about 30 minutes. Not too long. And I won't even call it a webinar. It's really just a conversation. Watch that. It'll tell you everything about how I do what I do. It gives you all the information about my 4-week course. It's live. It's pretty intense. It's an intensive, a 4-week intensive, but I try to get people through the majority of what you really need to know with none of the fluff. After 16 years, I can tell you there's a lot of stuff that people know and are learning that literally does not matter. Right? So if you need some help, you're ready to fully commit on a different level, I got you. Click the link below. Sign up, get the information. Right? And even if I don't see you in class, don't worry. More videos are coming. I got a lot more coming. Oh, I got a lot more coming. I'm excited. Thanks for watching. Share this video with somebody that you know and that you love. And enjoy your Labor Day if you're watching this live.